Let's just jump right in. You've probably been told that the absolute safest thing you can do with your money is to buy an index fund.
Set it and forget it, right? We hear it all the time. The idea is that it's totally automatic, completely neutral, and frankly, it is mostly really good advice. But that widely accepted belief hides a pretty massive secret that nobody really tells you.
You see, most people think an index fund is just one simple, unified machine. But the reality, an index fund is actually two completely separate companies. And the company making the really big decisions, well, it's probably one you've never even heard of, and that might genuinely surprise you. To make sense of this, we first need to take a step back and look at what an index actually is. Okay, let's start with the basics. A share of stock is just a microscopic unit of ownership in a single corporation. You can think of it like a single puzzle piece of a company's headquarters. When you buy a share, you legally own that tiny puzzle piece. But an index is entirely different. An index isn't an investment, and here's the kicker, it holds zero actual money. It is simply a statistical leaderboard or a shopping list, tracking specific companies. The S&P 500, for example, is just a famous leaderboard of 500 of the largest US companies. That's it, just a list. Now that we know what an index is, let's uncover those two hidden layers running your retirement accounts. So here are the two separate companies working behind the scenes. Layer 1 is the list maker. This is an index provider like S&P or Nasdaq, and they act exactly like a chef writing a recipe. They decide who makes the leaderboard. Then you have Layer 2, the money manager. This is a fund provider like Vanguard or BlackRock. They take your actual cash and act like a shopper, going into the market to buy exactly what's on the chef's list. And that brings us to the term passive investing. All this really means is that the shopper, your investment fund, is using an automated strategy. They are just copying the index's exact shopping list instead of paying a human stock picker to guess what's best. The shopper copies the recipe perfectly without ever injecting their own opinions. But because the shopper can't have an opinion, we run into something called the no choice rule. And this is where things get wild. Since the money manager isn't allowed to have an opinion, they operate under a strict mechanical rule. If the list maker decides to add a brand new company to the leaderboard, the fund must buy it, period. So step 1, the list maker adds a stock. Step 2, the money manager actually has to sell off portions of your great existing stocks just to free up cash. And step 3, the money manager is forced to buy that new stock, even if the price is absolutely terrible. This rigid mechanical rule creates massive friction in the market. When every single passive fund is forced to buy a new stock on the exact same day, this forced buying inflates the new stock's price. It creates huge artificial demand, and this actively hurts passive investors because you are the one forced to absorb those extra costs of buying high and selling low just to make room for the new arrival. To really see how this impacts your wallet, let's look at a massive real-world test, SpaceX. In June 2026, SpaceX geared up to go public at a staggering $1.75 trillion valuation. But here's the catch. They plan to release a tiny amount of shares to the public. Only a 3 to 5% float would be available to trade. This sets the stage for a massive index fund bottleneck, where way too much automatic money is forced to chase way too few shares. So how did the list makers react to this? Well, S&P rejected fast-tracking SpaceX because the company lacked a 12-month track record of profitability. But Nasdaq, they changed their rules to just 15 days, with zero profitability required. Why the difference? Because list makers aren't perfectly neutral. They have their own interests, and Nasdaq financially benefits from getting a massive, buzzy company like SpaceX onto their list early. And why does that rule change matter to you? Well, because of Nasdaq's sudden rule change, passive funds tracking the Nasdaq 100 were legally bound to blindly buy an estimated $7 billion in SpaceX shares within weeks of the IPO. This rule change means passive investors had to sell off portions of highly profitable great companies, think Apple, Microsoft, just to fund the mechanical purchase of a volatile new stock at a premium valuation. That artificial demand severely inflates the SpaceX price. It forces your fund manager to sell your other investments to move funds over, and ultimately you, the passive investor, suffer the hidden costs of this index dilution, even if you didn't actually want to own SpaceX shares in the first place. So why are list makers allowed to change rules that literally force you to buy stocks? This brings us to a quiet twist in financial regulation. First, we need to understand what a regulated entity is. This is a financial company that is closely watched by the government. They are subject to strict oversight, regular audits, and intense rulebooks designed specifically to protect your consumer savings. And heavily tied to that regulation is something called a fiduciary duty. This is a strict legal and ethical promise. It requires a financial institution to always put your financial interests ahead of their own. And here is the massive gap in the system. The money manager holding your cash, they are heavily regulated and bound by a strict fiduciary duty to act in your best interest. But the list maker, the one making the real decisions on what you actually buy, they are lightly regulated compared to funds and owe no fiduciary duty to the retail investor. And look, it's a debated topic for sure, but that's the reality of the structure right now. How is that even allowed? Well, the list makers rely on a debated gray area known as the publisher's exclusion. They basically argue that they are simply publishing impersonal financial lists, much like a newspaper publishing a top 100 list. And because of that, they argue they don't legally have to prioritize your best interests.
So what should you take away from all this?
Let me be incredibly clear. The point of this is absolutely not to avoid index funds. They are still a fantastic, totally reasonable choice for your savings. Broad market index funds remain one of the most reliable, lowest-cost wealth-building tools ever created. You should not walk away scared of them at all. But as we've seen today, someone is always writing the rules. Automatic investing doesn't mean no one is making decisions. Moving forward, understanding who drives the car and knowing exactly who is writing the shopping list for your life savings will make you a far more empowered investor. So keep asking questions and keep learning.